Hey guys, welcome to the podcast. Thanks for joining me. Stock market's closed and kind of churning around here at the 1500 level on the S&P. And last podcast we talked about the fact that things were obviously extended and a pullback was probable. On the flip side, strong markets don't let you in. You've heard that, and it appears that one of two things is happening. We're setting up for a pullback. Again, is it going to be a huge one? Not necessarily. I don't think it will. There's just too much demand coming in and not enough supply. But, we still could get a pullback. But what's happening is you're seeing some of these things kind of work off this, what they call overbought condition. So the market obviously gets very, very stretched up here. And as it moves sideways, it gives time resets, time heals, right? And so you're seeing some pause in the buying, but you're not seeing intense selling. There's a little bit of profit taking coming in, but you're still seeing on days like today, mid caps, small caps outperforming. That's healthy. Transports are still holding up. And so again, we're looking for cracks, and there's not any cracks other than the fact that the stock market obviously is stretched to the upside. But again, that doesn't mean it's necessarily going to go down. So if you're somebody that is waiting to buy and you have some cash, you have to be averaging in. As painful as it is, you have to be averaging in. Now, there's a portion that you do want to wait for it to pull back, certainly. And even the part that you're averaging in with, still have an exit strategy on all of that. But don't necessarily just wait with your cash and expect it to come back to where it was last June, at 1,300. You have to live for today and play for today. But what's happening right now is obviously there's still a somewhat of a rotation going on of money coming out of bonds and into stocks. Here's TLT, which is the Treasury ETF, 20-year Treasury. And you can see it's still under pressure. Obviously, it's going to have some up days when the markets are down or lethargic, and today was one of those. But overall, look, the Dow Jones, pretty much flat on the day. And again, after we had one down day the other day on, I guess it was Monday, down day, and then yesterday came back and pretty much got all those losses back in one day. And again, if you're somebody that's bearish and wanting to short, that's very frustrating. If you're somebody that's bullish, you're saying this is great. It won't even go down more than one day in a row. But Dow Jones was flat today. The Russell 2000 up about 1/3%. Mid caps were also strong, up about 0.5%. Interest rates were down. Now there is a debate going on whether or not this is the rotation that people have been waiting for. Remember, interest rates are right now at, we'll call it 2%, a little under 2%. 1.96 is where interest rates are. And we were kind of in this box for August, September, October, and it looks like we're breaking out to the upside now. But if we zoom out and go back 5 years, you can see where we are. And so, getting back to this old level here, and I've drawn a line of maybe 2.4, that would be the high I could see this going to. But there's an argument going on in a debate, because people are saying, look, the obvious thing that would happen is the economy is getting a little bit better, so money has to come out of bonds, and that money will be used as a source of funds and go into stocks, and we'll all live happily ever after. However, there's been studies done that say, look, anytime that you get interest rates going up and yield spreads widening, meaning things like junk bonds start selling off and basically risk off, you don't have good stock market returns. So it's real nice and easy to say money will flow out of bonds and go into stocks, but the evidence doesn't prove that. Now, the caveat to that is that we haven't ever been in a time like this before. We've had interest rates held this low, this long by a Federal Reserve. And so is it possible that interest rates could rise as the Fed lets their foot off the gas and money continues to go in stocks? Sure, it's definitely possible, but don't just assume that because stocks are going up, interest rates are going to skyrocket. I'm in the camp that says they could pop this year, but they're going to stay low. And look, I hope I'm wrong about that, because if interest rates go up, I think it's going to be because the economy does get better. But at some point, the Fed's going to let their foot off the gas. I know it's hard to believe, and it's probably not going to come anytime soon, but at some point they will do that. And that's going to be a real interesting thing to watch, because how are they going to unwind everything that they've done the last several years? And that's the debate's already starting. How they're going to do that? Will it be effective? Will it be very sloppy and messy? And I think the answer is yes, it will be, because they're not letting their foot off the gas yet. If they were, we would see it in the evidence, not what they say, but what they do. And we monitor all those types of things like the monetary base and the velocity of money. We look at those types of things to say the free reserves. What are they actually doing? Not what are they saying? Because they will say one thing all the time and they will go do something completely different. And right now, they're still printing money. They're still buying bonds, $85 billion a month. And so interest rates look like they can only go up so far. Now, there will be a day, obviously, that, God forbid, China and everybody else stops buying our bonds and interest rates go up and the Fed can do nothing about it. But that's not right now. Remember, consumers in the U.S. are driving sometimes what's going on in China, and it won't always be that way, but we still consume a lot in this country. And so it's in China's best interest and some other countries to keep our interest rates low, to encourage you and I to go over leverage ourselves and go buy everything in sight and have people that are living paycheck to paycheck and yet go buy $500 iPads. That's the society we live in. That's the society that China likes. So it's in their best interest to keep our rates low. How do they do that? By buying all the bonds that we print or invent. So this isn't going to end right now, I don't think, but could we get into a time frame where interest rates pop a little bit and get up into this 2.4? Definitely. That could easily happen. So again, if you own things that are very interest rate cyclical, long-term bonds, just bond funds, you really need to examine them. Look at what's called the duration of the fund, to determine what length of bonds do they own in there. How will they be affected if interest rates rise? That's one thing you need to do. And secondly, look to see, are you able to hedge yourself if interest rates start to rise? How hurt will you be by the funds you own, by the bonds you own? And so again, owning long-term bonds just doesn't make any sense at all. For people who say don't own any bonds at all, that's hogwash as well, because you should own some bonds. It's just what type of bonds. There are plenty of good corporate bonds out there that are good companies and are giving good yields. It's just that so happens that we get a good deal, but we are keeping those short. In other words, we're buying short maturities. So long-term treasuries as an investment, not a good idea. Any long-term bond fund, not a good idea. But shorter-term things and again, items that have the ability to hedge. Does your fund have the ability to hedge? Does your manager have ability to hedge? Do you have the ability to hedge out interest rates? So again, because they will rise at some point, and this trend that we've been in for years and years and years, as I zoom out, and obviously going all the way back to 1980, this only shows 04 as I do this weekly. If I go quarterly, we can get a little bit longer view. There's 1981 right there, September of 81. And interest rates were 16%, and we are now at 1.96. So this trend, as you can see, and it doesn't take a rocket scientist to draw this, but this trend, is down, obviously, and, interest rates could pop all the way back up to this area right in here, and we would still be in a downtrend. That's 3%. We could go to 3% over the next year as the economy strengthens. And if the economy surprises more people to the upside, which it is, people that were very bearish on the economy, me being one of them, have been surprised to the upside in some of the numbers that we're seeing. It's not blowing me away, but it's even stronger than I thought it would be. And so given that, if it comes in and surprises us even more, interest rates will continue to rise. And if they do, then you will see, obviously it could work its way up to 3%, but still not change the big picture of what we're going through, which is, again, everybody around the world printing, debasing their currency, meaning making their respective currencies and dollars worth less, inflating their way out of these issues that they have. And so interest rates would just continue to meander down here. But remember, when you go from 1.5 to 3, that's a big move, and that's a big loss for bonds if you buy them at the wrong time. And so again, if you're somebody that's in there buying, the TLTs of the world, which is the Treasury ETF, then again, going back several years, you're not at the top, but you're near a top. And let's say 130 was the top. Would you want to be buying it at 130 and riding it down, even if it gets down to 88? That's a huge loss. So interest rates don't have to go back up to 7 or 8 or 9% for people in long-term bonds to lose a lot of money. Also, you should be owning some things that benefit from rising rates. And those are floating rate securities. There's all types of things that benefit from rising rates. Those are the types of things you need to be positioning for now, because interest rates one day obviously will rise and start rising persistently and maybe very quick. I remember back in the financial crisis, they started after we had the initial spike, and let me flip the picture here. After we had the initial spike up in prices, interest rates rose from 2% and went all the way up to 3.8 in a very short amount of time as money came back in the stock market at the beginning of 2009. So interest rates can move very, very fast. People don't remember 1987, but a lot of people lost money in bonds in 1987. The stock market, coincidentally enough, was actually up 2% for the year in 1987. Had a crash in between, but it had gone up in advance. And so the bond market was really the story in 1987, not the stock market. So as we go back to the S&P 500, we're in this period here where it looks like it's a foregone conclusion that we get up to the old highs, which were back in the 07 time frame, 08 time frame, which was about 1570 or so, whatever, and we're at 1512. So it wouldn't be a shock to see it get up there. A lot of people have done some work on the cyclical nature of the stock market, and you look at some of these ramp ups that we've had, and we're entering a period where late February, maybe early March is the time frame that we get a meaningful correction. The 5-10% variety, not the 1 day variety that we had on Monday. So it does look like we're going to make a run for that old high and then roll over. So again, be careful in here, because we're very, very stretched in the short term, and I talked about that the other day, how stretched we were, and all we've been doing lately is turning sideways, and you can see that developing. Each one of these bars is a day. The wider it is, the bigger the range, and so we're gyrating around here, but certainly the days of going up every single day have ended for now, and now we're getting this kind of tug of war where the people that want to sell are able to get a little bit of traction because there's not as much buying coming in as there was. But again, what you need to be careful of is that the market doesn't just move sideways for another couple of weeks. All these different indicators we watch all of a sudden aren't overbought, and then the stock market moves up to another level. So again, in some of the areas I like right now is I like healthcare. You obviously know I like financials a lot. They continue to be in some areas undervalued, and I think that the banks, we're still seeing money come into the banks a lot. And in energy, although energy right now, the only reason I'm not buying energy is it's been a little too volatile, and really what I'm looking for right now are things that are performing well but aren't very volatile. That's the nice combination that we all look for. And so, but energy's been great. But today was kind of a bifurcated energy market, because we had the oil and exploration ETF doing very well, up 0.63%. On the other side of the coin, we had the oil and gas equipment services ETF flat, or little down on the day. So kind of strange. And then of course when you combine the two and get the whole big basket, XLE was flat on the day. So you're starting to see some segmentation as far as in energy, but energy still looks good, but it definitely looks, as the market does, a little bit toppy, as it was running up and now it's simply moving sideways. Now, before I wrap this up for the day, I do want to talk about one interesting thing that's kind of hard to measure, and which is what makes the stock market really go. You look at a company like Amazon, and there's so many other companies out there that are fundamentally cheaper than Amazon. Amazon obviously ran up in the 90s on no profits. Then it started having a little bit of profits, and but the stocks continued to move up. And yet there's other companies out there. Well, let's take Apple, for example. That's moved down, and has continued to move down, even though it was cheap to begin with, and now it's even cheaper. But going back to Amazon, there's something Amazon has that a lot of other companies, frankly, don't have. And longtime mutual fund manager Bill Miller came out today and basically said he thinks Apple is 50% undervalued with a 50. It's about $225 higher than where it is today. Puts it at about 680 or back to where its old high was. And what he pointed out was that, and it's a good point, that Apple has something that companies like, I don't know, Nike has. And I'll throw Starbucks in there as well. Companies like those have it's the it factor. It's the name recognition, the brand. That's something that is very hard to put a value on. And what's happening is those companies investors tend to ignore some things or defend those stocks for various reasons, but they kind of have the it factor, right? For example, Nokia, doesn't quite have the it factor that, or even BlackBerry, which used to be called RIM, is now BBRY. Those companies, they don't have the Apple it, and that doesn't mean that the stock can't go down. I mean, obviously Apple has gone down, but generally those companies tend to get money flowing back in at various times. I mean, and again, it's what is it? I mean, I could go through each of these companies. I mean, Amazon, for example, it's a pleasant experience shopping on Amazon. I can go on Amazon and literally in less than about 15 seconds find what I'm looking for, punch a one-click button on my phone, and have the thing already sending me a confirmation email that it's on the way. And that's worth something. Obviously, they also don't have as much inventory as companies like and companies like Best Buy that have all the inventory sitting around, and snotty-nosed kids come in and they're picking up the stuff and banging it and playing with it, and then they set it back down and never buy it, and they're holding all this inventory. Whereas Amazon a lot of times is simply a middleman, right? So you could argue some of that, but it's an easy thing to use. It's great to use, and they pretty much dominate what they do. But the valuation of the company makes no sense. Now, there's also a company like Facebook. Is Facebook in that same category? Is Facebook a company right now that has the it factor? I don't know. I'm not a huge Facebook user. I use it for business purposes. I don't use it for personal reasons at all, just because I don't want 15 girls from high school trying to contact me. Anyways, but but the thing is with Facebook, does it have that it factor where everybody just says, hey, there's no other competition, and so it doesn't matter what the valuation is, we're going to buy the stock. And I think Starbucks has that. I think Nike has that. Those companies just tend to do things right. They have some missteps along the way. Starbucks did. They grew too fast. Then they consolidated. The stock got hammered. But here they are coming back because they still sold a bunch of coffee during that transformation. Nike still sells a bunch of shoes during whatever transformation they had. And Amazon, will Amazon come out with the next cool thing? I mean, right now, part of the problem is people are settling for older versions of the phone. They're saying, I don't need to get the latest and greatest because the other older one's just as good as the new one. That's not good. When you're developing products, you need companies to come out and say, develop stuff that says, I have to have that. I have to. And Apple had that for a while. They don't seem to now. But yet they're being thrown out as if the company's the next RCA, which has been tossed around that they're the next RCA, which is ridiculous. I mean, Apple had a little bit of a pop today because of the Bill Miller comments. They also had the rumors that they were going to do a huge stock buyback, which, by the way, they didn't give any guidance in their last earnings report. A lot of people thought they didn't do that because they couldn't calculate what their earnings might be in the future, put an estimate, because they hadn't decided how much stock to buy back, which affects their earnings. So, there's a lot of stuff going on, but the bottom line is they're in a very good position fundamentally, and I've said this many times, fundamentally I do think things have deteriorated somewhat from 6 months ago, 9 months ago, a year ago, but I also think that the stock has gone down faster than the fundamentals have deteriorated. It wasn't an expensive stock before. It's not an expensive stock now, but they're in a position now where they're going to have to prove some people wrong. If they do, it'll be just fine. It's still a good investment when you look around the landscape and say what stocks are out there. But they do have that it factor still, and overall they're going to continue to do quite well. I think it's just, again, they're going to have to prove some of that, and a lot of these companies like the Starbucks, have proven time after time to do that, and that's why I think you do see Amazon, and it does frustrate some shorts that Amazon continues to be at these lofty levels when the valuations make no sense at all. But what is that quote-unquote it factor worth? How do you value that? And it's obviously worth a lot of money in Amazon's case. So I just wanted to comment on that, because that's something that confuses a lot of investors, and it makes it hard when you're going to buy something, because we want to value it. We want to put a price that is comfortable to us, that we're willing to buy. And sometimes companies like Facebook and Amazon, it just doesn't make any sense why it's doing the things it's doing. Conversely, I will say, that's why you see companies that are quote-unquote value stocks sometimes get punished and go down, because they just don't get it. Even though the stock's cheap, they don't get it, and they don't have that it factor. So anyways, don't forget, folks, carleggers.com, eggerscapital.com, Facebook, Twitter, Google+, iTunes. We're on all those different venues. Have a wonderful evening, and we'll talk to you soon.